Okay, welcome back. Today, I actually want to reply to something I saw on Reddit. This is from r/QYLD gang. Don't judge me. But the title is Significant Cash on the Sidelines and Too Scared to Deploy. At least he's being honest. He goes on to say, combined with a recent property sale and some existing idle cash, I have about $500,000 ready for deployment. My goal is income. Pure passive income. I don't care too much about growth, it's welcome, but I don't plan to rely on it. I already have some other long-term positions for growth. I'm striving for 60K or better passive income in a year. I think this is achievable. I already have about 15K income a year. What is the best way to play this? All in immediately, which is a lump sum investment, dollar cost average, which is 20K a month for 2 years, wait for a pullback, buy some protective puts. So this guy has a ton of questions, and in this video, I want to show a few sample portfolios that I made that could address this guy's concerns. So I have one that's maximum income, more growth, and then a defensive general portfolio. But the first thing I want to address is actually this bit about deploying the cash. Should he put it all in immediately, or should he dollar cost average 20K a month for 2 years? Now, Vanguard, of all people, have actually made a public statement on this that might surprise you. So it says, on average, an immediate lump sum investment has outperformed systematic implementation of strategies across global markets. This conclusion is consistent with finance theory, as immediate investment exposes cash to historically upward trending markets for a greater period of time. If an investor chooses to invest systematically, we recommend keeping that time frame to no longer than 1 year. So this might seem counterintuitive. Isn't dollar cost averaging a good thing because in case the market goes down, you're averaged into the market? But the issue there is you're looking at the whole situation wrong. So the whole point of investing is to take excess capital and put it to work to generate you additional capital, right? That's what it all boils down to. That's what you're doing. So by putting a lump sum in the market, you're putting as much capital as possible to work as fast as possible to give it the most time to grow and compound. Because after all, the difference between gambling and investing is that investments tend to go up over time in value. If I continue down on this article, they have a bit on buying the dip. So it says, this buy the dip conversation usually happens when the market reaches all-time highs, suggesting that one should hold some cash and wait for the market to drop and then buy in. This sounds nice in theory, but reality tells a very different story. The simple fact is the market hits all-time highs quite often, and they're usually not followed by dips, so you're more likely to get stuck just sitting around holding cash. Here's a pretty staggering statistic to illustrate. 24% of months have been record highs in the US stock market historically, and only 1.14% of those months have been followed by a decline greater than 10% within the 12 months following. So this just helps to illustrate why a lump sum investment is usually the best way to go, because those market dips don't come by as often as you think, and when they do come by, what's the odds that you can actually take advantage of it? We just had a massive market dip in March of 2020. How many of you guys timed that perfectly? I bet not that many, including myself. I didn't time that perfectly either. So to address that first portion of his question, lump sum investing is usually the best way to go. You don't have to go to the extreme and do all of it, but maybe lump sum 60% of it and then dollar cost average from there. But as the article said, don't allow the dollar cost averaging to go on beyond 12 months. That's a little bit excessive and you're not putting the money to work. Okay, but getting to the investment point, he wants to generate as much income as possible, and he doesn't care too much about growth, although it's welcome. So the takeaway I get from that is he just wants competitive total returns, right? You don't want to lag behind the market that much. The focus is on current income, but you want the total return to be decent. So with that criteria in mind, that's how I generated these 3 sample portfolios that could be a solution to this guy's problem. Now, before I dive into those portfolios, I want to quickly give an overview of the funds that I chose, because all of the portfolios have a combination of these same 5 ETFs because they're all very diversified, different strategies going on, but they're all focusing on income, and I think they're some of the best at achieving that. So allow me to quickly explain these ETFs. So DGRO, I view this one as a mixture between growth and dividend, right? It has a 2% dividend yield and great total returns in the past 12 months. This is how it screens for companies, so they need 5 years of uninterrupted dividend growth, a payout ratio less than 75%, and they avoid the top 10% of high dividend companies. And that leaves the portfolio looking like this. So we have names like Microsoft and Apple, along with more traditional dividend companies like Johnson & Johnson. So that's why I say this is more of a hybrid between growth and dividends. A great ETF though. The next one is SCHD. This one definitely focuses more on exclusive dividend companies. It's still a pure equity ETF, a 2.84% dividend yield, great total return in the past 12 months, like really exceptional. And this is the screening process, a bit more in depth. They want 10 years of consecutive dividend payments, a minimum market size of 500 million. They want free cash flow to debt, return on equity, the average dividend yield, and a decent 5-year growth rate in the dividend. And that leaves you with companies like this that are the traditional dividend companies: Pfizer, Pepsi, Home Depot, so on and so on. The next one here is getting into covered calls to generate more income. So that's why it has a 7.24% dividend yield, and this is NUSI. The way this fund works is they buy the underlying index, which is the NASDAQ 100, and then they deploy an option collar strategy. So allow me to illustrate with an example how this works, because I'm a big fan of it. So this is a price chart. Y-axis is the price, the X-axis is the passage of time, and this yellow line is the current stock or index price. So they put a call option 10 to 15% out of the money, and a put option 10 to 15% out of the money as well. So this is your downside protection, and they buy this using some of the call option premium. So that's why the dividend yield isn't as high as, say, QYLD, but it gives you downside protection. So what this results in is an investment that is designed to move sideways between this range, and this whole time it pays you out a hefty dividend because of the call option. It does limit your upside because the call option is there, so if the price goes up too high, it gets called away, so that limits your upside, but your downside is also limited because of the put option. So the put option gives you a right to sell a specific stock at a specific price in the future. So that's your downside protection. And if we come back to the price performance over the past 12 months, we can see this play out. It's operating between this narrow range, going sideways, and giving you a hefty payout along the way. And then we have QYLD, which is just one of the highest dividend ETFs you can buy. I'm not the biggest fan of this because I don't think it's sustainable, but this is how they operate. So the fund writes index calls to cover 100% of their portfolio with at-the-money strikes 1 month out. And it does that again and again, super simple. And it's based off the NASDAQ, so you have these companies in the top 10 holdings. But important note is you're not actually investing in these companies. It's just the reference index that you write covered calls off of. So all of your gains and dividends are the call options. This is just the reference index, so don't get that confused. QYLD, of course, has a call option, and this call option is at the money. So that means the strike price is basically right where the index is currently, which gives you absolutely no room for price appreciation because the call option is right there, limiting your upside. They do that because it generates the highest premiums and dividends. But they also don't have that protective put down here, which means that you have unlimited downside potential if the index crashes. And then lastly, I selected JEPI. This is also using covered calls, but it goes about it in a completely different way that still offers downside protection with a lot more upside potential, as you can see here. So it has a 7.4% dividend yield, and in the past 12 months, it's gone up 26%. And it does this by creating a portfolio of equity securities with a lower volatility level than the S&P 500 index, and also investing in equity-linked notes. It's an 80-20 split, so 80% of this ETF is just straight equities found in the S&P 500, and that's what allows this ETF to have good price appreciation. It's not limited by a call option. Now, this other 20%, the ELNs, are essentially call options. This is what generates the income, and they're just a fancy financial instrument that does the same thing as call options, but they're called ELNs here. And this is what that looks like. So these are those ELNs that generate the income. And then the other holdings are just companies found in the S&P 500. So you're going to see some growth names like Microsoft and Google, and then some dividend names like Target. And because 80% of this ETF is just equities, that means it can freely go up and down with the market, and that will potentially give you more price appreciation in the long run. But then there's also those ELNs, and those ELNs operate in the background and consistently generate you income. So I represented that here by a plus $2 per share, just a random number, but that's just a baseline of income generated by the ELNs every single month. And that gives you downside protection because if the stock price does crash, say it goes down $5 per share, you always have this base of $2, so it can help to offset some losses, giving you downside protection along with great income and the potential for a lot of upside capture. Okay, so that's my logic behind the ETFs. Now let's go through all three of the potential portfolios to generate a lot of income. So we're going to begin with the maximum income portfolio. So this one has a dividend yield combined of 9.6%, and it's mostly made out of QYLD with some NUSI. They both generate a lot of income, and that's why we have a combined dividend yield of almost 10%. You're not going to have great price appreciation by any means. This is really focusing on maximum income, and it does rely heavily on QYLD, which I'm not the biggest fan of. So personally, I would not go this route. The next one we have is more growth. So if I click into this one, we actually have 3 ETFs. So the largest holding by weight is SCHD, and this is a great pure equity dividend ETF, around 3% dividend yield. Great performance. I love this ETF. We also have DGRO, which is kind of that mix between a growth and a dividend ETF. So I tossed that in here to have more growth. And then I also have NUSI just to generate more income because that is the primary goal. And it's going to give you some downside protection as well. Of course, it's going to limit your upside because of the call options, but that's why we have SCHD and DGRO. So overall, it has a dividend yield of 4% and pretty awesome price appreciation. We can see in the past 12 months, it's gone up 24% with over a 4% dividend yield. So that's extremely respectable. And then lastly, we have the defensive choice. Personally, if I had to pick one of these 3, this is the one I would go with. So we have a combined dividend yield of 7.3%, extremely high, definitely achieving the current income goal, and split up 50-50 between JEPI and NUSI. So both of these use call options, but they do it in a completely different way, but they both have downside protection and super high dividend yields. So as mentioned, NUSI has the caller option, so they have a call option up top and a put option down below. JEPI, on the other hand, is more dynamic. So 80% of the ETF is just equities found in the SP 500, and that's what's going to be responsible for giving you more potential for price appreciation in the future. And the other 20% is those ELNs that give you a consistent, steady stream of income. So that's why when you combine it, they have a super high dividend yield of 7.3%, solid downside protection, and some upside potential because of the equity position. So if I was this guy or I inherited some money, the first thing I would do is deploy it immediately in a lump sum, because the faster you can put the money to work, the more money it's going to generate you. And then I would make a simple portfolio of ETFs like JEPI, NUSI, SCHD that's going to give me consistent payouts, some downside protection, and the opportunity to participate in market upside. So let me know what you guys think in the comments down below. I hope you enjoyed the video. If you did and you're still watching, give it a like, subscribe to the channel, and I will see you in the next one.